Hey, good morning, everyone. Marty Missouri here, March 2nd, 2024, with your weekly economic update. We will do the usual. We'll look at a few of the inputs to our PWA index. I'll discuss what the overall picture looks like relative to that data. I'll highlight some commentary from recent earnings reports as the earnings season is winding down, and continue to, with you, track along the macro setup for markets and give you our perspective, and clients give you some insight into why we're doing what we're doing these days in terms of portfolio management. So just to begin with, our index actually moved a little bit back toward the positive trend, still negative, still in that area that says recession odds are too high for comfort, but we went from a minus 19 to a minus 17 over the past week. We saw deterioration to the extent that would lower the scores in places like mortgage purchase applications and durable goods orders, improvement in heavy truck sales, and some serious improvement in market-based, equity market in particular, signals about the economy. So what I have loaded up for you right here first is consumer spending. That data came out this last week. And point two, as you can see the trend here, but point two was at expectations, so nothing surprising the markets there. Personal income really popped 1% month over month. You get into the details, looks like high dividend payments, high rental income to some, large government transfer payments. So it didn't really do much in terms of reaction in markets because it's explained away by somewhat unusual, if not seasonal, factors. Savings rate actually ticked up a little bit here. It's been careening lower as people have been dipping into their savings. This has been flagged as evidence that people are getting out over their skis from a spending standpoint. We're also seeing that in credit card delinquencies, auto loan delinquencies, and so forth. My observation has always been that it begins to tick up as people get nervous about their go-forward outlook, and you can see that these red shaded areas of recession. You can see that those pickups ahead of virtually every recession over the last several. I mentioned mortgage purchase applications. They're down for 4 weeks in a row, and of course that's going to be correlated to rising mortgage rates as inflation has kind of ticked back up, or maybe not fallen as like people had expected at this juncture. It's being reflected in the bond market for sure. The stock market really got hit hard for a day or two by the hot CPI. Recovered, and I'm going to say that recovery had a lot to do with NVIDIA's blowout earnings once again. But the bond market has continued to reflect that with higher yields, and that's reflecting here in mortgage purchase applications. Consumer confidence ticked down just a bit, so it'd been ramping here. A little bit of a rollover, nothing to panic over, but consumers, they certainly have their concerns, not the least of which still is the price they're having to pay for goods and services. But it's also, we're seeing some weakness in their overall view of job conditions and that sort of thing. Speaking of job conditions, unemployment claims ticked up a bit here. What I'm really eyeballing here is continuing claims, folks. I am sympathetic to the notion that there's a lot of labor hoarding going on these days, that this relatively low jobless claims is as reflective, if not more reflective, of companies having such a terrible time finding and keeping good people post-pandemic, to now that they have them or have what they have, that they certainly don't want to let them go. So you're seeing still historically low jobless claims, ticked up a little bit here the last week or two. However, continuing claims are continuing on the rise. So these are people who are on unemployment and continue to go back each week because they're not finding new jobs, and appear as job openings clearly in a downward trend here as well. That feeds into the recession thesis, which, based on our overall observations, has to be our base case for now. But as I've said here the last couple of weeks, we are seeing some pockets of strength, and I'm going to highlight that for you right here. ISM manufacturing index, the results of the survey came out yesterday, which was Friday. Monday or Tuesday, we'll get the services. It's always a day or three later. It actually went down, so that's not necessarily what I just set you up for, meaning it's not a good look to see the manufacturing space contract at a faster pace, which is what that means. But when I actually get into the report and read the details, it's more consistent with what we've been seeing of late. Demand is at the early stages of recovery, and production execution is relatively stable compared to January as panelist companies begin to prepare for expansion. And they give you more detail there, of course, as well. And then they feature 10 respondents' comments. And so from the chemical products, currently seeing increased sales in our business. Most delivery dates are in the second quarter of 2024. From transportation equipment, the first quarter will be slower due to some customer order changes, but we are expecting the rest of the 2024 to be strong. We may increase our growth projections. From machinery, demand has finally picked up with customer orders more closely resembling typical January and February levels. January was up 22% compared to December. February up 26% compared to January. From fabricated metal products, customer orders are steady, neither up nor down compared to last month. Primary metals, the month seems to be getting stronger with each passing day and week. And electrical equipment, appliance, and components, we are experiencing increased sales, which is putting pressure on the plant and assembly to meet new customer demand. So this is what I've been talking about, is that these are the kinds of signals that we really look for at bottoms to actually even begin scaling in to some of the positions that we're excited about during the next cycle. This, I still say, is a very unusual setup. Now, we have had clearly a recession in manufacturing, and maybe we're coming out of that. But we really have had anything but a recession in the services space. And now we're beginning to see some of those real-life pressures on consumers where we may begin to see that. So this could be somewhat of a head fake. I mean, we can go back on just about any of these charts. You can see before the Great Recession in 2008, manufacturing rolling over than services, and then you see this big, nice pop in here, a few months before, and then finally we rolled over into recession. You can see similar action here before the early 2000s. Of course, Wall Street's going to be screaming from the rooftops that the economy is fine. We have to be cautious because of all these mixed signals. And we also have to recognize the fact that when we're talking equities, for example, we came into the year with the anticipation that the Fed was going to cut interest rates 4, 5, 6 times. And if the economy is bottoming and some of these forward-looking inflation figures are bottoming as well, well, you're not going to get those rate cuts. I think the Fed, they'd really like to cut rates. They really want to cut rates. If they go too deep into the year, it's going to look very political if they do it. So it's almost like if they do it, they're going to have to find an excuse before mid-year. And this economy and the inflation data isn't helping their cause any. So it's going to be very interesting, folks. The notion that at these levels of valuations with the consumer maybe feeling some heat right here. Yes, manufacturing beginning to pick up, and make no mistake, the fiscal spending from the federal government injected into this economy this year. It helps at the margins, but again, does it help markets when we have this inflation bugaboo that everybody is still dealing with and concerned about and so on? So if we have a recession, earnings are coming down and prices of stocks, for example, don't reflect earnings coming down. They actually reflect earnings staying up and interest rates coming down measurably. So there's lots of potential disappointment at these levels for the market to really do what it would need to do to get valuations to make sense. But let's make no mistake, markets can stay irrational or expensive or bubbly, if you will, for extended periods of time. It's just that the longer they go, if indeed they are bubbly and valuations don't indeed ultimately make fundamental sense, the worse it gets, on the other side of it. I'll be doing a stock market update here in a couple of days, and I think we'll get into positioning and leverage in the market and so forth, just to continue to express that this is not a setup that would have us, bolting into the market, backing up the truck, taking early cycle positions like small caps. Longer term, our thesis, and we think it's very solid at this point, shows some serious opportunity globally across asset classes. But we got to get there first. This cycle, in our view, has still got more work to do before we're ready to engage in early stage, next cycle kind of investing. Okay, so that was went a little longer there than I anticipated. Let's go on. I think I mentioned in the intro, market-based indications. Each line here is a sector relative to the S&P. The text about right there. Financials a little underperforming, but we get to consumer discretionary, notably outperforming the S&P. Materials notably outperforming the S&P. Energy slightly outperforming. Industrials notably outperforming. And then you get to your defensive sectors that do better during recessions. Underperforming, staples notably, utilities notably underperforming, and healthcare notably underperforming. So this went from neutral to positive in our index in terms of what it says about the economy. I've been flagging the staples to discretionary ratio. I showed you last week that it popped up. It was like 2.2%, and it went down into the negative. So this last week, discretionary stocks massively outperformed consumer staple stocks. So that says equity markets, are acting as if a new recovery is underway. Now, with regard to what happens if we don't get any more of a slowdown, look at the Baltic Dry Index. It tracks shipping costs across the world. That has spiked up hugely. So that's a price indication. Of course, that could bleed through to inflation. Now, this is a very noisy input to our index, but we do pay attention to it. And typically when I see a spike, I want to see if we're getting confirmation in things like the World Container Index. It's actually rolled over a little bit. And then the Shanghai to LA container cost, it's still very, very elevated, very inflationary, but it's come off the boil here a little bit as well. Okay, so let's pull up Peter Bookvar's commentary. I've mentioned before, we appreciate how he goes through all of the earnings report, or his team does, and then summarizes the commentary. So Dell Computer, our strong momentum in the AI build-out continues, as we believe Dell is uniquely positioned with our broad portfolio. TJX, we saw comp sales growth across each of our divisions again, all driven by increases in consumer transactions, so more volume. Dine Brands, the trends in January were tough. Weather took its toll. But since then, as the weather has eased, we've seen traffic improving. Bloomin' Brands, sequential U.S. comp sales and traffic improved from Q3 to Q4. Hyatt Hotels, leisure transient revenue increased 6% in the fourth quarter, lapping a strong quarter in 2022. As we entered high season for most resort markets in America's revenue for the month of December was 21% higher than the same month in 2019. So good news, at least from that particular vendor to travelers. Now, negative leaning commentaries. Best Buy. At the highest level, there have been and continue to be macro pressures impacting retail overall and consumer electronics more specifically. First, inflation has been slowing, but prices for the basics like food and lodging are still much higher, and consumers have to prioritize and make trade-off spend decisions. Second, there is a consumer propensity to spend on services like concerts and vacation in lieu of goods, which has remained sticky, even as the prices there too have inflated. Third, we have a relatively stagnant housing market. Fourth, consumer electronics was a significant recipient of a pull forward of demand during the first 2 years of the pandemic. That makes sense. And lastly, the level of consumer electronic product innovation has been lower during the pandemic and supply chain challenged years. It's not so much about each of these individually, but when you stack the five, it has been a heavy weight on the industry. So Papa John's, a more cautious consumer, they talk about, is hitting their business. Dine Brands, I guess there's good and bad from that one. On the negative side, we have seen that our guests have been remarkably resilient in 2023, but we're also seeing from consumer behavior perspective is that they are making choices about where and when to dine out. They're dining out a little less often. And when they dine in our restaurants, they are finding our value portion of our menu. So people are starting to get a little more discriminatory when it comes to eating out and so forth. From Macy's, likelihood of a recession is now lower than it was a year ago. Inflation has slowed, but so has labor and wage growth. As such, we expect our consumer to remain under pressure On the credit quality situation, the first thing is that the customer remains under pressure, and as a result, what we're seeing across the industry are higher credit card balances and higher delinquencies, and I touched on that earlier. As you know, the last few years had an abnormally low or historically low level of net credit losses, delinquencies, as folks were flush with cash, but now we're back to more normal times. And so what's reflected in our credit card revenues, which does exclude the impact from the late fee ruling, is really the increase in net credit losses as we're more in a normalized environment. So Macy's is talking down a little bit what we're seeing in a lot of the charts and what others are saying about credit card delinquencies. They are acknowledging that they're rising, but in their world, they're just now getting to more normalized levels. In economics, folks, what you do, though, is you look at direction and you look at rate of change. So you can look at levels, but you go through normal levels, of course, on the way from lower levels to higher levels. So we'll think about that and watch that as we move forward. eBay, moving to our outlook, we have started the year with relatively uneven demand across our major markets. Lowe's, in the fourth quarter, comparable sales declined 6.2% as do-it-yourself customers continue to remain cautious with their home improvement spend. Microeconomic factors like persistent inflation and stagnant housing market continue to make do-it-yourself customers and consumers hesitant to spend on big-ticket purchases for their homes. They go on, but I can stop there. Urban Outfitters, turning now to the health of our customers. We believe they, as a group, are in good shape. They're not as exuberant as they were when first coming out of the pandemic. They don't have as many weddings and events to attend. They're less apt to move and have recently refurbished their living spaces. So demand for categories like dressers, footwear, and home furnishings are trending softer, but they do enjoy a secure job and are earning more money than ever. They tend to be optimistic, want the latest fashion, are willing to spend some of those extra earnings to enjoy them. I guess this fits in the negative category because they aren't as exuberant and so forth, but that certainly doesn't sound too dire. Dell, here's a negative. Turning to Q4, we saw positive signs in the business as we exited the year, but enterprise and large customers remained cautious with their spend. PC market is still soft, and we expect the recovery to push in the second half. So, folks, that's why I mentioned this AI craze. So Dell, under the surface, really didn't have great things to report other than their push into AI. Hewlett-Packard, similar to peers in the market, we saw campus networking products demand weaken, and the decline late in the quarter was greater than expected. Large headwind relative to our expectations. Customers are taking longer to digest prior orders than we had anticipated, and so on. It goes on. And so on. So that's the last one on this list. So, folks, I think there's, fodder there for both the bulls and the bears. I certainly am open to the notion that that we could get a soft landing out of this. I still think that's the least likely of the possibilities. We are going to end up in a recession sooner or later. I think there is a lot going on to try to avert that from policymakers, but they have the inflation problem. If they try too hard to avert recession, then inflation becomes a real problem, and the ability to cut rates is going to be hindered markedly, and that's a problem for the market. Our base case is that before this is all said and done, this cycle will play out like other cycles have. And you will see inflation come down, but the earnings decline is what will hit stock prices the hardest. That is still a scenario that carries high enough odds that keep us from investing like we were, say, from 2009 to August of 2019. But we will get there. We'll either get there through market offering up valuations in areas that we're looking to add and scale into that are compelling given macro conditions, or macro conditions getting to a point that makes present valuations something that would make folks like us who do this kind of work comfortable adding to. Now, we are invested in many places, and we are able to make money as markets make money. It's just we're not trying to hit any home runs right here, folks. Singles and doubles are fine under these circumstances. I'll leave it there. Thank you, as always, for watching and listening. Be back soon. Take care. Bye-bye.